Thanks to our friends at the Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. On March 10th, 2023, the FDIC took over Silicon Valley Bank, and the U.S. saw its first major bank crisis since the global financial crisis more than a dozen years before begin to unfold. A similar bank called Signature Bank was also shut down by the FDIC, which took over and formed a bridge bank for both of these businesses so that customers would have access to deposits. Billions of dollars in investor capital was wiped out seemingly overnight, and a lot of people are learning for the first time lessons about how banking really works. And even those of us that have been through banking crises before are relearning lessons again. This is The Smattering. I'm Jason Hall. We're going to talk a little bit more about some of the lessons that we've learned. I've got Tyler Crow here with me to talk about it. Hey, Tyler.
You ever hear that term like decades can happen in a week? I feel like a lot of people have learned decades worth of banking lessons in a week because of what has happened recently.
I think that's a really good way to put this into perspective, because here's a piece of context that I think is really useful. Silicon Valley Bank had filed its annual report at least a month before the events occurred that happened so quickly. So we generally had a good idea of its financial state, its balance sheet, and the risks that really led to its failing in terms of the assets that it owned, those long-dated assets versus the short-term liquidity needs of its depositors. And we got a decade in a week, it feels like.
Yeah. It's been an interesting time. It seems one of the frequent things that I like to listen to is the Odd Lots podcast. And it seems like I have learned more about banking regulation, banking liquidity, basically, like, I feel like I just took a crash course in banking in a week, listening to podcasts, reading what has happened. And it's been to me, as much as I'll admit, like, I've stood on the sidelines for a lot of this, being somebody who was less familiar with banking, less familiar with financials leading up to this. I know it's a little crass to say this, but to me, this has been an incredibly educational moment in time that really is going to probably shape how I think about banking going forward.
Let's get into that. Let's talk through some of the big lessons that we've learned. I'm going to start off with the biggest lesson that I've learned, and I want to put a little bit of a backstory here. If you go back to February, you and I recorded a video. You were my sidekick. I don't want you to get looped into any blame here. I want to own this mistake and not let you get associated with it. I went so far as to say that I thought Silicon Valley Bank was potentially once in a decade buy. We did talk about some of the risks. And needless to say, making that call like 6 weeks before the bank failed is a terrible look. And I think the biggest lesson that I've learned is something that I already knew, but I was taking for granted. And that is that with banks, generally failure is a product of a loss of confidence more than anything else. Bankers make mistakes. They make bad bets, maybe take on too much risk. Things start to go badly. Depositors lose confidence, and they go take out their deposits, and the bank fails. That's generally the way these things unwind. I made the mistake in this case, number one, of forgetting the importance of confidence. Confidence is king, as banking expert John Maxfield put it on our podcast when Jeff Santoro and I had a conversation with him. And so that's part of it. But the 1A is I forgot we're so hindsight biased. We spend all of our time fighting the last war. And I was not thinking about the potential exposure to risk that a hyper-concentrated bank like Silicon Valley Bank could have in a very different way. That's not about the assets that it owns, but more about its depositors and concentration of those similar depositors that really created the risk. Because without a bank run, Silicon Valley Bank probably would still be a solvent, functioning institution. But that loss of confidence and that hard run upended everything. What about you?
I'm going to pull in three threads, and it's the thing that's really started to bind together for me for financials and banks and thinking about them going forward. Prior to this, 3 or 4 months ago, I really started looking at long-term winners in the market. Like, what are some of the sectors that have produced a lot of long-term market-beating stocks? And if you go into the banking sector, there is a lot of them. Like, over the course of time, there are a spectacular amount of small regional banks, really smaller than SVB Financial and some of the other ones that have struggled lately. But there's a lot on that list of, if you look at their history, they have beaten the S&P 500. So there's a lot of them out there. And then there's this concept of, I remember reading Nassim Taleb quote, where basically it was, when a bank fails, it fails spectacularly. There's really not a whole lot of in-betweens with banks. And then, again, I was just mentioning with like Odd-Lots podcast. One thing that they mentioned too is the regulatory frameworks that were established in the 90s under Greenspan really put the onus of regulation on shareholders. There was like this idea of, we're going to get so overwhelmed with supervisory regulation that we're just going to we're going to have some set rules. They're called bright line rules. And as long as you meet these procedural kind of guidelines, we're going to leave it up to shareholders to regulate. Shareholders are greedy, so they might not also always be in the best ones looking for risk management. And so pulling all of these threads together, the thing that really makes me think about banking from here forward is, I don't need to look for my bank to be an outperformer, because the industry itself is an outperformer of the market. You just need to find ones that keep its feet on the ground, ones that are some of the least risky, some of the most conservative in their underwriting and their hedging risk, duration risk, all of the risks that we have talked about over these past couple of weeks. Rather than trying to chase the high growth banks, you're much better off looking at the more conservative ones, because over the long run, it's just an outperforming industry. And even if you're just an industry performer, you're probably doing better than the market anyways.
My last lesson is I'm going to kind of Charlie Munger inversion principle, what you were just talking about. Finding the best banks is less about finding the ones that do the best during the bull markets, but finding the ones that do the least worst during bear markets, during economic downturns, during crises, because those are the smart managers that don't chase growth when everything's good, when money's coming in and they're just trying to grow faster than their competitors. They're happy to stick to their knitting because they know eventually the tide's going to go out. There's going to be some other bankers that have been swimming naked, and there's going to be opportunity to take their business away from them when they struggle and fail.
That is so hard. The willingness and ability and just the mental fortitude to avoid taking on those risks when everyone else is, to avoid that temptation to satisfy shareholders who are saying, hey, you're losing to your peers. What are you going to do about it? The ability to do that and say no is hard. And I don't think we should underestimate the management teams that are capable of doing that, because it is so hard.